This is Tom Nunemaker with Capital Discussions. This is my trading update for Tuesday, September 2nd, 2014. So we had an interesting day today. The market opened higher and stayed higher for a little bit. Then we had a pretty good sell-off and the market bottomed and rallied back right where it basically started. So it probably closed, well, let's see exactly where it closed. Let's go to the indexes. SPX was down $1.41 after all of that. The VIX futures looks like they're all in contango, nothing really to worry about. Euro is a little bit down, but pretty much unchanged. All right, so the VIX, this is the cash, kind of spiked up a little bit with this excitement, and then came down a little bit, and then we had this big drop, and the VIX hardly moved at all. And this was kind of a tell for Jim that the market really wasn't too serious about this. And if you look at the futures, it's like nothing happened. You know, if you just took this red line away and just tried to predict where the market was going just based off of the VIX and the futures on the VIX, you'd say, well, it was a pretty quiet day, but you know, it really wasn't. But this was a good signal that this bottoming was actually, you know, a good time to buy and get long. So if you're an intraday trader, maybe this is something to add to your toolbox to look at the VIX and the futures and just gauge the reaction of a big move to see, is this something the market's really worried about or not. All right, so with that out of the way, let's take a look at some of the other charts. Here's our SPX 3-month chart of a daily bars. Looks like we're still in a range-bound situation. Had a pretty good move. Let's see, the high to low was 2006 down to about 1995. So we had a 21-point intraday move, and you can see the bar is a little bit taller than the other bars around it. So it's getting a little bit squirrely, but it's still hanging right at 2000, isn't it? All right, so let's take a look at the euro because I'm still in a euro trade. Euro continues to go down. If we look at, this is a 1-year chart. Let me pull up maybe a multi-year chart. It'll be a little noisy, but okay, so you can see we're really testing this low, and then the next one would be down here around 127.5. So I'll remember that when we come back to our euro US dollar trade. All right, so let's take a look at option view. So I've got the 6E futures options position, which is on the euro US dollar. We saw a price chart and we can see it also in option view. It's selling off, which we knew. Now let's take a look at the volatility. It's still spiking up as this downtrend continues, but it's still pretty low. You know, we're talking 6% volatility. The currencies don't move, you know, a lot. So they can get some pretty big moves if, you know, the banks are talking or something, but the interest rates are pretty low. So let's I don't anticipate a lot of big moves unless maybe to the upside, but we have lots of room on the upside. In fact, there's no risk on the upside. So let's take a look at that. Here's our birdie. So remember we said we could get down to maybe 127. That would be a support area. Well, that'd be down here. Now that would be with no adjustments. So even if we hold it to expiration at 126.5, 127, we would still make our profit on this. So right now we're underwater, mostly due to volatility, but there's still a lot of time left. There's still, let's see how many days. There are 67 days to go, and our shorts are at, let's take a look here. Shorts are at a minus 9.8 delta. So I think we put it on around an 8 delta, so it's ticked up a little bit, but really not too much. It's still 2 standard deviations away if we use the SV, which is the standard. If we push in the put at the money volatility of 6.3, what does that do? It looks like we're about, our short strikes about 1.5 standard deviations from trouble, which is still pretty good. So if we pull that up on this chart, this is where the implied volatility is putting the standard deviation bars at. So even with this, there's still a 93% probability of profit because there's so much time. And you know, we started, it was maybe up around here. So it's sold off, sold off, sold off, and it's only moved a little bit. And as time goes by, obviously, that's helping pull this line up too. So, you know, a nice slow decline we can handle. So with that said, let's actually punch in the right numbers for this trade. So with that said, let's see how our P&L is doing. Okay, I've loaded in the current prices. Now remember, this is a Globex product, so if I look at the current prices, it's actually trading right now as we speak, and it's, what time is it? It is, well, after midnight Eastern, so it's down just a little bit, and you know, it's we're down about $600 on the trade. But again, I'm looking at this chart. That's mostly due to volatility. If I pump the vol up a little bit, that puts, maybe that's a little too much, 0.8, 0.9, something like that. So if we zoom in, we can grab this thing too and zoom in. Maybe 0.85, 0.8, 0.7. Oh, that looks about right. So I've got the Graham dot right on the middle of the volatility. So if we zoom down, yes, we'll lose some money, but again, there's still a lot of room to go. And even here at T plus 34, this is 2 standard deviations. Now we're not going to let it get that far. If it gets down to here, maybe in this area, depends on how fast, obviously. You know, if it waits a couple weeks to get here and we're still at break even, we might not do anything. If it does it in the next week or less, then maybe we'll add another put spread to kind of raise this up. And what would that look like? Let's take a look. That would look something like this. And let's superimpose it so you can see the difference. So it would push the T plus 0 line, or the expiration line, down below 0. It would raise this up and extend this out, and it would kind of flatten our T plus 0 a little bit. So we'll see if we need to do that. I'm not convinced we do yet. You know, the market's been selling off, so at some point it's going to try and stabilize. Right now it's one of those let's catch a falling knife kind of situation, but it's been up around 140 and it's approaching 130. So you know, here we are with this 1 year support, so I'm anticipating it might stabilize a little bit here, which is all we want. We want just to slow down and kind of stop, maybe bounce around here, and that'll be fine. Let a little theta kick in. So that's where it is right now. Let's take a look at SPX. Let me load the prices and we'll start. Let's take a look at SPX. Okay, I have our SPX prices loaded in, and let's take a look. Right now we're up $1,700 for all our SPX positions, and if we look at the analyzed chart, it looks like this. It's got multiple expiration dates, but it's a pretty nice looking chart, and even at this, let's see, that's a 99% probability profit, which is looking pretty nice. Let's take a look at the individuals. So we have, well, let's start with this since it's already up. This is the September 19th expiration in 17 days. It's up about $500, and it's looking like this, looking pretty nice. Hoping it just stays around here and bumps up a little bit more. Maybe, you know, to this line or this line, so we can get 1,000, 1,500 out of it. Now, the one that's expiring sooner, this one expires in 11 days. This is the one that we've got no risk on. We're just basically locked in a $1,200 profit, remember? So right now it's trading here. If it expired today, it would make, oh, let's see, at this price it would be $14.43, so it'd make another $150, something like that, $180. And the December trade, and make this a little taller, looks like this, and we're again right at the money. So here we are, we're basically break even at this point, and we're actually down $49. So on a $2,000 trade. That's pretty close to break even. And our theta is what? $9. So if it just stays here, it'll take another week and we'll be in the black. Now if we're playing for this line, that's a 75% probability profit. This one's 68, 51, and this will be a lot lower, 22. So if you think about it, we're kind of playing for one of these two lines, and this is 54 days and this is 27 days from now. So 1 or 2 months away. So if we can hang in for a month or two and get in this range, then we're in pretty good shape. We'll be up, 1,400, maybe 2,000, 2,500 range, somewhere here. Even if it goes up, then this could still make, a couple $100, but if it does start going past, say, this point, this upper long, what could we do? We could start peeling off this side, right? So basically adding bullish spread. So we could do something like this, which would start lifting this side up. Or the other way you could do it, and this would use more capital, you could lift it on this side. And that kind of a similar effect if we overlay them. You see they're pretty close but slightly different. And it doesn't use that much more capital, a little bit, but not too much. So we could add this bullish vertical. Now this makes the most money at 2025. We'd probably want to make the most money above the short strike, so we probably want to do something like this. And that would raise it up nicely. It increases the risk a bit, quite a bit actually, kind of triples the risk, but it gives us a nice profit area here. And again, as the market keeps moving, you can just keep adding more of these put verticals, and as it comes back, you could take them off. So that's that trade. So overall, we're looking pretty good again on our SPX. That's the combined. And the euro, we're hoping it's going to stabilize again. It's still quite a ways off before expiration, but we'll keep watching it. So that's my update. Thanks a lot. Bye.